Hey there, hope all is well. Back at you today with some more RTD news updates. And as you can tell from today's title, Frexit, global debt, and pensions, we're going to be talking about a few different topics today. And so I'm surrounded by the City of Dallas flag. I'm surrounded by the EU flag. I'm surrounded by some euros. I'm surrounded by Marine Le Pen. And so we're going to cover various articles here. I figure it's best to just give you an overall viewpoint of what's going on right now and what's making major headlines. And so we'll dive into that. But before I do, I actually want to inform you of tonight. At 8:30 p.m. Eastern Standard Time, me and Elijah Johnson from Finance and Liberty will be sitting down to do a RTD live talk and have an open conversation on various topics. And looking forward to you guys hopefully calling in via Skype at RTD Live is the Skype user ID. And just call in and share your thoughts and just, chime in on what's happening with you and some things that might be of concern to you. So let's dive into today's article. So here I have about 8 articles, as I mentioned. I'm going to just thumb through them briefly, give you an idea what they're about. And as always, you can find the links below to get more details on exactly what they cover. So the first article here is from the Express in UK. And it's a worst nightmare for the EU has French election could be between 2 candidates wanting a Frexit. And so we're going to get into that one. The next article is also from Express, and it's Brussels rages at Le Pen after Front National leader refuses to stand next to an EU flag. So things are heating up over there in France right now. The next article here is from Bloomberg. It says Larry Fink, warning signs are getting darker for the U.S. economy. Next article here is from U.S. Global Investors, and it is entitled Get ready for inflation, lumber logs at 12-year high. So if wood's going up, that's I guess going to be an indicator as to all around prices that may be going up. Next article here is from Zero Hedge, and it says in stark warning, IMF finds over 20% of U.S. corporations at risk of default should rates rise. And so right now we're in the midst of the Fed raising rates and things like that. So definitely won't be a good thing. And the next one here has to do with the Brexit from The Guardian. It says Brexit's unpredictable outcome poses risk to global stability, says IMF. So we have the Brexit, we have the possible Frexit. So, a lot of things happening globally here. And the next article here is from Markets Insider. It says global debt has hit an eye-watering $215 trillion. $215 trillion. Interesting. Next one here, and last article here is from the Texas Tribune, and it says Dallas officials say state lawmakers share blame for city's pension woes. So, going to be talking about them pensions in Dallas, which I'm hearing is not doing too well nowadays. So let's dive into the very first article. And as always, I want to keep this nice and short, actually shorter than prior interview or prior news segments, just so you can give you an idea of what's on the surface and you can go dive deeper if you're interested. So first off right here with the Express UK says worst nightmare for EU has French election could be between 2 candidates wanting Frexit. So let's scramble through it real quickly. Says far left candidate Jean-Luc is enjoying a surprise rise in the polls to join front leader Marine Le Pen as a feasible anti-EU choice in the contest. It said after weeks of poll predicting a showdown between Mr. Le Pen and European socialist Emmanuel, Mr. Pelinchen has a sudden surge in the polls after performing well in the television debates in the run for the unpredictable election. So both of these guys are talking, or both of these individuals rather, are on the Frexit stance and whatnot, but yet probably share different viewpoints overall on how that will take place. And so it gives you some pictures here of them too. And then it says the communist-backed candidates want to pull the France out of the EU as well as the military alliance NATO. If the more left-wing supporters from candidate Emmanuel switch to Mr. Mélenchon, a Le Pen Mélenchon second round is increasingly likely. The French newspaper Libertarian declared Mélenchon as the most convincing French candidate in an opinion poll. And so here we got some more stuff here. Briefly, it says journalist Andrew, imagine a second round Mélenchon versus Le Pen as existential crisis for France and the EU. Polls say Mrs. Le Pen, who wants to hold a referendum on France's membership in the European Union, as well as quit the euro, is almost guaranteed to make the second round of the election. It says France is one of the core members of the bloc, and a Frexit would trigger another EU crisis. So EU crisis is not good, being that there are so many other nations in that same little block of nations there that are struggling via debt, as well as just pending referendums and elections coming up. So definitely not some good news coming out of the whole France thing. Here's another article here. It says Brussels rage after Le Pen after front national leaders refuse to stand next to an EU flag. So I'm not sure if that's kind of telling on her stance about her being anti-EU or what, but we'll just see what they have to say about it. So here shows Le Pen, who's running for the Prime Minister of France, and it says here the outspoken French national leader cranked up her anti-Brussels rhetoric during a TV interview yesterday. It says she said, "I want to be the president of the French Republic. I don't want to be a European Commission president. I believe the European Union has done a lot of harm to our country." Ms. Le Pen, a fierce critic of the 28-member bloc, made the comments ahead of Sunday's presidential election. She refused to be interviewed in front of the EU flag, a decision which sparked outrage from Europhiles. Said the European Commission's representative office in France said the flag was a symbol of unity, solidarity, and harmony. Next one here, it says Ms. Le Pen, Deputy Florine Philippot, responded fiercely on Twitter. He wrote, "You'll see, we'll soon stuff your oligarchic rag in the cupboard." So little backlash right there with that one. So more if you're interested in reading about it. Next one here from Bloomberg. It says Larry Fink, warning signs are getting darker for the U.S. economy. So here we are about to cover some of the possible recessionary type talk here in the U.S. It says U.S. market may fall 5 to 10% on weak profits, Trump setbacks. It says U.S. is the slowest growing economy among G7 nations. And so here it gives you a little video presentation of what he's saying. It says Lawrence Fink, Chief Executive Officer of BlackRock Incorporated, said the lackluster growth of the U.S. economy and uncertainty around Trump administration's ability to quickly pass key reforms pose a risk to markets. He's quoted as saying, "There are some warning signs that are getting darker," said Fink. In an interview Wednesday on Bloomberg Television, Fink, who runs the world's largest money manager, mentioned a pullback in car sales and a slowdown in merger and acquisition activity as indications that uncertainty is rising. The slowest economy among the G7 nations is the U.S., he said. So here's a man that runs, as it says here, the biggest, money marketer, money manager rather. And if he says things are slowing down, somebody that, people tend to listen to. So it says the stock market needs validation that the U.S. corporate earnings will stay strong and that the policies of President Donald Trump regarding taxes, regulation, and infrastructure will advance in Congress in order to move higher, Fink said. It says if we don't have earnings validated in these higher PEs, we would adjust downward 5 or 10% from here, Fink said. If the administration does succeed on some of these items, then the market will then reassert itself going higher. So he's questioning, whether or not Trump can kind of pull off some of the things he's promised. And if he doesn't, he's saying we can expect some type of correction in the market. So interesting guy worth taking note of. So more if you're interested below. Next article here is from usfunds.com, and it says, get ready for inflation. Lumber logs a 12-year high. So here it gives you a little chart here. It says, as if you need more proof that inflation is finally starting to pick up, lumber prices rose to a 12-year high last week, supported mainly by expectations that steep duties will soon be levied on cheap softwood imports from Canada. Lumber futures rose to nearly 415 per thousand board feet last Monday, a level unseen since March 2005, soon after home ownership peaked here in the U.S. And so it gives a little chart here. It says lumber logs 12-year high, so it goes a little decline during the recession, and then it peaked a little bit. Now it's climbing. So definitely not good numbers overall. It says as issue is a mini trade war between U.S. and Canadian loggers. For some time now, the American lumber industry has blamed its Canadian counterpart of unfairly dumping lumber in the U.S. that's far below market value. Now several factors are pushing timber prices higher. Chief among them are the likelihood of duties being raised on Canadian border, possibly as early as next month, President Donald Trump's calls to renegotiate NAFTA, and growing demand for new homes following the housing crisis as consumer optimism improves and millennial buyers finally seem eager to enter the market. So looks like a little trading war due to the whole NAFTA talk between our president and his other nations that are in the NAFTA agreement. So we'll see how that all pans out. But that's something, NAFTA is something he definitely talked about taking to the table and beginning renegotiating. So we'll see how that pans out. Next article here says from Zero Hedge, in stark warning, IMF finds over 20% of U.S. corporations at risk of default should rates rise. It says while the market has been generally euphoric over Trump's promise of fiscal agenda, one adverse side effect which has largely been ignored by the markets is the impact of rising interest rates, not only on sovereign debt, but on record corporate debt loads. Conveniently, this was one of the most notable topics covered in the latest Global Financial Stability Report released by the IMF on Wednesday. According to the IMF writes, a corporate leverage has risen and is now the highest level since the start either the financial crisis or the dot-com bubble, depending on which metric one uses. So it gives you a little graph here showing you how, the recessions here. We have the median energy. We have all the firms here, and we are, obviously reaching some points where it's IMF is talking about their concerns. It says so too has the proportion of income devoted to debt servicing, notwithstanding low market benchmark borrowing costs. And while the absolute level of debt servicing as a proportion of income is low relative to what is going during the global financial crisis, the 4% point rise has brought it to its highest level since 2010, which leaves firms vulnerable to tighter borrowing conditions. The average interest rate coverage ratio, a measure of the ability of current earnings to cover interest expenses, has fallen sharply over the past 2 years. It says, meanwhile, the IMF warns that earnings have dropped to less than 6 times interest expense, close to the weakest multiple since the onset of the global financial crisis. So the IMF is giving a heads up as to how the things are getting a little tight on their end, and where they feel is worthy of coming out with their reports and giving some pre-warnings of what is to come. So if you're interested, there's more information as well as graphs below. Next article here is from The Guardian about the Brexit. It says Brexit's unpredictable outcome poses risk to global stability, says IMF. So IMF is, giving more of their insight based upon their data. International Monetary Fund has warned that Brexit's unpredictable outcome poses a risk of global financial stability at a time when it's already challenged by heavily indebted U.S. corporations, China's credit bubble, and weak European banks. It says warning that banks were likely to be the sector of the city hardest hit by Britain's departure from the European Union. The IMF said cost of doing business would rise and regulation would become more complex. It says half-year global financial stability report, one of IMF's 2 flagship reports, said the benefits of London as a global financial hub stemmed from the economies of scale and its expertise across a range of industries. While the IMF acknowledges that there was significant uncertainty about the outcome of the 2 years of Article 50 negotiations, it added that the challenges stemming from Brexit could undermine financial stability in ways that are difficult to estimate or predict at this juncture. It says IMF also noted that there could be financial stability benefits if Europe had a less concentrated banking system. The Washington-based organization said global financial stability had continued to improve, helped by a pickup in the economic growth. So once again, it kind of hinted at if the banks weren't so big and so interconnected, that it might not be that much of a problem if there was a hiccup in the economy. But because all the banks are connected and our system is pretty much driven by financial institutions, they're at risk, which means the people are at risk as well. So more information below if you're interested in reading more about it. The next one here is quite telling. This is about the global debt. It says global debt has hit an eye-watering 215 trillion. 215 trillion. It says global debt levels soared over the past decade, while the vast majority accumulated by emerging market nations. According to figures from the Institute of International Finance, global levels of debt held by households, governments, financial institutions, financial corporations jumped by over 70 trillion in the past decade to a record high of 215 trillion, equating to 325% of global GDP. So that right there, those numbers are beyond even trying to really paint a picture towards, but yet the fact that it's 325% of GDP lets you know that this debt will never be able to be repaid. So here's what the increase looks like, looking back not only over the past decade, but also the decade before. So here we have a chart here, a graph rather. It says total global debt, all sectors. And so U.S. trillion percentage of GDP. So 1996, we had emerging markets was 126% of GDP, and then they were 146, now they're 215. And then we have the mature markets. We have 280% as of 1996 of its GDP was tied up in this debt. And then we have here 348, and now it's 390. So Once again, as these charts continue to climb, it just brings to light the idea that this will never be able to be repaid. It says the bars are getting bigger, especially in emerging markets. U.S. is in dollars, 215 trillion. That's followed by 3, 6, 9, 12 zeros. According to the group, emerging markets indebtedness increased by 40 trillion over the past decade, a significant acceleration on the U.S. 9 trillion that was added in the decade before. It says it currently stands at 56 trillion, or 215% of emerging market GDP. So, yeah, definitely some things worth considering is how will this debt be repaid? Unfortunately, it will not. And that will mean that there will be a lot of financial and monetary casualties that's tied into this debt, because all the financial institutions, all savings, investment, retirements is all tied into this same system of just indebtedness, to where it will be very hard on civilization altogether. Next article here is from the Texas Tribune, and it's on the Dallas pension. It says Dallas officials say state lawmakers share blame for city pension woes. It said amid a legislative session that aims to fix massive pension shortfalls in two of the Texas' biggest cities, Dallas officials argue it's state law that created some of the current problems that it faces. So here, give you an idea what's going on. It says a Texas legislator doesn't send any state funds to the belligerent Dallas or Houston pension systems, but legislators nonetheless find themselves mediating city-level disputes over a collection of bills aimed at shoring up at least $14 billion in the city's collective shortfalls. Under a practice that dates back to the least Great Depression, state law dictates that a lot of financing, governance, and benefits of dozens of local pension funds. Some say it's good to use checks and balances. Others say it's another example of the state controlling local matters and dictating how a city's money should be spent or must be spent. It says if, quoted by, if they mandate that we have to contribute a certain amount of general fund to a particular use, that's a mandate they're not funding, said Lee Kleiman, a Dallas City Council member. The legislators now are not kicking in a dime. So we have state trying to dictate to the city what they should and shouldn't do. These are some things happening in the news, short and brief. And as always, I want to just remind you that tonight, RTD Live with Elijah Johnson, we will be talking and just getting a chance to just cover various topics, and looking forward to the opportunity to have you chime in, share your thoughts and what's on your mind. And also, if you haven't had a chance, I put together an infographic, the Dollarcation infographic, which is detailed information of our monetary history of this country. Definitely some detailed information that could be used to sharing with your family and friends. Other than that, this is today's RTD News. Enjoy your day. Thanks.